Today, we are going to be looking at analysis of the higher time frame versus analysis of the lower time frame and how you can use them to make good trading decision. What do we do in the Forex market? Very simple. We buy and we sell. How do we know when to buy and how do we know when to sell? And that is why the knowledge of technical analysis is very, very important. What is technical analysis? Technical analysis is the ability to use historical price level to predict what the actual price will do in the nearest future. For instance, if I want to know what GBP USD will do probably next week, there is need for me to study what it has been doing in the past. There's need for me to study what it has been doing in the past. This is the monthly time frame. Okay, so if I am able to understand what is happening within this region up to this present state, then I should be able to infer or probably come up with a conclusion that this week, this is what I'm expecting GBP USD to do. Okay, so that is that about that. Now, there are so many things that are involved when you talk about technical analysis. One of the most important things you have to pay attention to whenever you're talking about technical analysis is what? Your candlestick. Your candlestick, they are very, very important. You cannot, like the importance of candlestick in trading cannot be overemphasized because virtually everything, every decision you want to make in the market is based on what the candles are saying. For instance, some of us, depending on the language we are speaking, if you go to a different location, you will find it difficult to communicate with the environment or with the people in that particular location because they don't understand the language you're speaking. So making some decisions there will be very difficult. You may end up putting yourself into trouble because there are things you will say which might probably a thing of peace in your own language, but then to them it's something that has to, promote violence. So there is need for you to understand what the market is saying for you to make a good trading decision. So candlestick is the language of the markets. Like I said, this is just an overview of the Forex market so that you know what to do and where we are heading to. Candlestick is the language of the market. It helps you to make good trading decision. It's the candlestick that will tell you when to take a buy position in the market and when to take a sell position in the market. Now, when you talk about candlesticks, there are different names that are given to different candles, but their names are not solemnly important, although it is good for you to know what they are called, but that is not the priority. The priority is that when you see this candle, what is it representing in the market? That is the most important thing that you should pay attention to. Now, when you're talking about candlestick, you need to understand the concept of time frame. You need to understand the concept of time frame. What do I mean by that? You need to understand that, okay, this is what a particular candle is doing at a particular period of time. It is very important. For instance, when you look at the chart and I ask you, what is GBP USD doing for the past 2 hours? You should be able to look at it and give me at least a good percentage accuracy of what GBP USD is doing within the specified period of time. So time frame, understanding the concept of time frame is very, very important in making good trading decision. And that is the reason why today we are going to look at multi-time frame analysis, which comprises of what? Higher time frame analysis and lower time frame analysis. Now, I'm going to talk about the higher time frame analysis in a bit. Now, when you talk about higher time frame analysis, yes, you are trying to understand what the market has been doing in a specific period or in a specific period such that when you are making a trading decision, you can have a good range that, okay, this is the behavior of the market for this particular period of time. Take, for instance, before me, what you're seeing on the screen here is the monthly time frame of GBP USD. What that means is that this is the behavior of the market for some months. Now, each of these candles you are seeing here, because we are on the monthly time frame, each of these candles you are seeing here represents 1 month. Okay, irrespective of the size of the candle, you can see that some are bigger than other, some are almost of the same size, but irrespective of the size, each of these candles represents 1 month. For instance, this particular candle you're seeing here, this particular one that I'm trying to highlight now, this big candle here, where my cursor is at the moment, this particular candle represents 1 month. This small one, where my cursor is also representing 1 month. It took 1 complete month for this candle to be formed. So for this particular month, if I ask you that what is GBP USD doing for this month, you will give me a good answer by telling me that this GBP USD is actually selling. Okay, so that is that about that. If I scale down to the 1 week time frame, each candle you will be seeing on the 1 week time frame represents, like, is formed after every 1 week. It took 1 week for this candle to complete its formation. It took 1 week for this candle to complete its formation. And I think this candle, okay, it also took 1 week for this candle to complete its formation. So that is that about, as you scale down, this is daily time frame, this is 4 hour. Whichever time frame you find yourself, just understand that that time frame, that particular time, represents the time it takes for 1 candle to be formed on that particular time frame. Okay, having said that, what are the benefits or what are the importance of higher time frame? Higher time frame gives you, number one, higher time frame gives you the overall bias of the market. What do I mean by that? Overall bias of the market is telling us the general direction of where the market is going. Because as a trader, you don't just want to jump into the market and then you start making mistakes or start making wrong trading decisions. You buy, you see the market, 1 candle going up, you quickly click on the buy. It's the next minute you see the market is coming down, and then you are regretting, what am I doing wrong? I thought this market was going up. So these are some of the mistakes that young traders make, and because they don't understand the concept of what higher time frame analysis and lower time frame analysis. So the higher time frame helps you to understand the overall bias of the market, that where the market is going in general. So that is one important benefit. For instance, if you look at the charts, from within this zone up to this point, you can simply understand that this market has been bearish for the past how many weeks. Okay, you see the market coming all the way to this particular direction. So the market has been, it's just that it's trying to change. There's something they call change of character. I don't want to bore you with so much words today, but there is such a thing known as what? Change of character. So that is what the market is trying to do here, but that is not our business today. Today we want to understand what the higher time frame can help us to know. So how will you on your own try to practice the importance of this higher time frame? Now, when you come to your chart, try to switch your time frame to daily, weekly, monthly, to see where the market is, where the market is heading to. Is it going in the upward direction or is it going in the downward direction? For you to be able to know where to join the move. Secondly, the higher time frame help us to identify our psychological level. What do I mean by psychological level? They represent our support and resistance. They represent our Fibonacci level. They represent our, our trend, like what the market is doing per time. So these are the importance of what the higher time frame. Okay, it helps us. It gives us the overall bias of the market, help us to identify our important zone, and these psychological levels, they are levels where we expect the market to probably, make some reaction in terms of reversing. For instance, if I draw a support line here, if I draw a support line here, if I draw a support or a resistance line per se, between here and here, what this line is helping me to note is that the market came to this point and it started reversing to the downward direction. It came to this point again, it reversed to the downward direction. It came to this point, it reversed to the downward direction. So having all of these things that price have done in the past, the next time the price will be coming to this particular direction, or to this particular level or zone, as a trader, I will be able to bring my knowledge of what it has done in the past, that, okay, because of what happened here, there's possibility that price will also come down a bit before it decides to do anything. So this is one of the importance of higher time frame. Now, after you must have understood what your higher time frame is doing, it's also important that you merge it with your lower time frame. It is very, very important. Now, your lower time frame helps you to find entries into the market. Okay, your lower time frame helps you to find entries into the market. So the summary of what I'm saying from the beginning of higher time frame versus lower time frame is, when you want to do your analysis, you want to know whether you are buying or you are selling. And for you to be able to do that, you need to understand the direction the market is going to. The time frame that will help you identify that or solve that problem is what? Higher time frame. Now, after you must have known that this market is going to this particular direction, the next question is, where do I enter from? Or when should I enter? That is when the lower time frame comes in. The lower time frame helps you to know when to make the decision of entering into the market. Secondly, it helps you or gives you good risk to reward ratio. What I mean by that is, if you are making a trading decision on the higher time frame, you will have a very big stop loss. But when you are making trading decision on the lower time frame, you will have a very tight stop loss. And when your stop loss is tight enough, you will have good risk to reward ratio, meaning you will be risking just a small amount of money to win a substantial amount of money. Okay, so that is that about that. Now, which time frame should we consider as higher time frame, or which one should we consider as lower time frame? Now, your monthly time frame, your weekly time frame, your daily time frame, and your 4-hour time frame will represent your higher time frame. Okay, your monthly time frame, your weekly time frame, your daily time frame, and your 4-hour time frame represent your higher time frame. Now, when you talk about lower time frame, you are talking about 1-hour time frame. You're talking about 30-minute time frame, 15 minutes time frame, 5 minutes time frame, and below. Okay, so these are entry time frame, and they help us to have good risk to reward ratio in the market. So that is that about higher time frame versus lower time frame.